As we move towards the end of 2025, it's time to take stock and gauge exactly what the year ahead has in store for us. This video focuses on the indices space and, of course, a major nod to the AI trade, given the fact that it appears to be the thing that's driving everything, in particular over in the US at the moment, good and bad. But this is part of a wider series where I've also produced one on gold and silver, the precious metal space, which, of course, has been booming. Also one on the FX space, and it will wrap up with a webinar at the beginning of next year. So make sure you join myself and Mahanad where we go through our outlook for 2026, covering those topics and a lot more. So for this one, let's get into all of the nuts and bolts of what's driving markets and what could drive markets up and down over the course of 2026. So I've got a whole host of charts to show you, so I can't spend too long on each one, or else this is going to be an hour-long video in itself. But hopefully this is of value to you because it underlines exactly why markets go up, why we could see markets go down, where we could potentially allocate money to try and diversify, or whether we shouldn't diversify, or whether we should choose different regions or different sectors. I try to go into lots of different bits of detail that hopefully will be of use to you. So let's kick off with this. Now, this chart I think is absolutely critical because when you're trading some markets, let's say, for example, the likes of euro dollar, right? There might not necessarily be an underlying trend that means it should go in one direction or another. And generally, the FX space is one thing traded up against another. And that's why you typically don't see the same kind of trends that you might see within particularly the indices space, but also the commodities space. But this really underpins why equity markets over time go up. And that's because earnings are driving valuations, and earnings, as long as they continue to increase, then you see a side-by-side improvement in terms of the stock market. Now, the caveat to that is that things can change because either the earnings direction starts to roll over and we have a different outlook, let's say with the pandemic and everyone's shut down, suddenly those earnings just aren't there. Or else there's a shift in terms of sentiment about the possibility of things being different down the line. And that means that you see markets attribute a different value or multiple to those earnings. So earnings could go up, but if people suddenly become very fearful, they might say, well, 30 times valuation isn't right. It should be more like 28 times, 25 times, and then you see a pullback in the face of rising earnings. Right now, we are seeing rising earnings. Earnings remain strong. Much of the question marks around the indices space will come down to a question mark on whether those multiples are justified. In the tech space, of course, that's been grabbing the headlines, but that will remain the case across the board, and it always is the case whether people think there should be higher valuations or lower valuations attached to a stock or an index or a sector. In terms of the outlook going forward from FactSet, the S&P 500 target, according to bottom-up analysis, essentially this is trying to look into the businesses, the expected growth of their earnings, and taking all of that, putting it into the S&P 500 as a whole. What's the expected earnings growth of all of the companies within the S&P 500, and what does that take us to in terms of the target for the S&P 500? And as we can see here, it's close to that 8,000 mark. Now we're at 6,830 as I record this video. So it points towards plenty of room for upside. Now, the caveat to that is if you're looking at bottom-up analysis, you're talking about the growth of earnings. And that means there's a view that the multiple stays pretty much the same, which might change certainly depending on sentiment. It may improve further because it has been climbing in terms of the price earnings ratio over the years. That's why we got so extended. Or it might pull back because people are increasingly fearful and they don't necessarily want to pay that additional premium for something they think is about to blow up because of the AI trade, most notably, but also could be around the direction of travel for the economy. From a sectoral position, this is the breakdown in terms of which sectors are expected to gain the most in terms of the target from FactSet. So you can see here IT, so big tech, real estate, consumer discretionary, And as you can see, as we go down, things sort of normalize a bit. But certainly you're looking at the potential for sort of 19% upside for big tech or the tech space, real estate 17%, 17 consumer discretionary materials, utilities 16, communication services, and as a whole 15.5 for the S&P 500. Now, when we're talking about that chart in terms of the direction of travel for earnings, I guess you could say, well, if the multiple remains the same, then we can just look at the growth of earnings for the index over the course of the year and expect the index to rise that much, i.e. earnings for the S&P 500 went up 10%, therefore the S&P 500 should grow 10%. It's a very simplistic way of looking at it because, of course, there's a lot more that goes into it, most notably sentiment. But as long as earnings continue to grow, it does form the basis of strength for the markets. And so you can see here, in terms of the expected earnings that we're going to be seeing coming into the next year, well, look, things are on the rise. Certainly, you can see here in terms of the year 2025 earnings. Of course, we haven't seen Q4 earnings. 12.1 for earnings on growth, 6.9 for sales or revenues. And over the past couple of years, they have been increasing year on year. So if we see increased earnings, will that be enough, or will it be a case of people thinking, well, we expected more, most notably within the AI and the tech space? In terms of the direction of travel for the US economy itself, that's another story in itself. Of course, there's always that question mark of, is the market and the economy the same thing? Of course, it's not, because you can see a weak economy that draws out a response from the Federal Reserve, which means they have to cut rates. And so the stock market goes up, but we're seeing weakness in terms of the economy. And that's something we're to an extent seeing at the moment. US GDP, by and large, has this long-term growth trajectory. We're a bit below it over the recent period, but generally it's roughly around that 2% area. Now, that's significantly higher than what we're likely to see in the UK in particular, but many of the European countries won't grow at that clip. So that highlights why many will continue to see the US as a relatively high growth area, because it's not compared to other parts of the world, in part because it's so big. But certainly from a relative basis, I think it's likely to be higher in terms of GDP compared to the likes of the UK and some of the areas in Europe in particular. In terms of the moves we see within markets, I think one of the things that we've seen recently is some major jitters around AI at the back end of the year, and that came after earnings came out really strong. So it begs the question of, how is the year ahead going to play out? Well, as we can see here, the general trajectory for the S&P 500 is upwards. That's why people all look at it as probably the safest bet out there. They say, well, if you look over the last 100 years, it gained 10% every single year on average. And therefore, this is the best place to park my money. But more recently, we've been seeing some jitters, in part because of the policy fluctuations under Donald Trump. And now because of the fact that we've seen such a strong run up off the back of these AI names in the tech space, that there's question marks on whether it's gone too far. What this highlights is that you can see sort of corrections very frequently, every year, every other year, but it's pretty infrequent that you see that the actual bear market moves coming into play. So corrections over 10% decline, bear market over 20% decline. You can see here the bear markets essentially are just around like really massive events. Your global financial crisis, the pandemic. The question mark here is, have we got enough for that? And there's certainly a huge myriad of risks ahead of us. And we'll sort of note some of those in this video. I guess the question mark is it going to be so bad that they can't actually rescue it with policy, or is it something that is actually going to crash the economy? And certainly, I think the AI space is the one area that at the moment people are really focusing in on and saying, if this thing blows up, look at the kind of valuations we're looking at and the value destruction that could happen if we did see a major collapse in some of these names. But there's other areas as well. The huge growth of debt that keeps just getting rolled over and built up and built up. Is it going to come to a point where we need to see some pretty drastic measures? Certainly the moves for the BRICS nations away from US treasuries and into the likes of gold really does highlight this recalibration away from the US dollar and away from US assets. So we could see some sort of crisis emerging from the bond market in particular, and the Japanese bond market could be part of that, as well as yields go upwards. Bear in mind, this last year we've been seeing elevated yields in the face of rate cuts. That is not normal, and does highlight the fact that the demand just isn't there. So they have to keep offering higher prices yet. But essentially, this chart really highlights you will see the odd 10, 15, 20% pullback. But those sort of, as we see here, 60% pullback, 25%, 34%, they're pretty rare. Instead, it's a lot more normal to see what we've seen recently, which is your 5%, your 10%, your 15%. And generally, as we see from the long-term trajectory, they end up being good buying opportunities. As I said, we have a huge amount of debt that's rolling over and needs refinancing in the year ahead. Anyone that sees this chart and has been in the game for long enough to know what it looked like a year ago, they'll realize it keeps looking like this. And the reason in part is because a lot of the debt gets rolled over at different time frames, right? So not everything gets rolled over on a 30-year, for example. Some of them get rolled over on the 1 year and the 2 year. And so they just keep coming back to bite you. And more recently, because of the fact that interest rates have been so elevated because yields are so high, we've seen the shorter term issuance coming into play a lot more. Now, it makes sense, right? Because, for example, if I'm remortgaging my house, if I have very high rates to pay on it, why would I lock in a 20-year or a 10-year or a 5-year? Well, I wouldn't do it. I would look towards a shorter term and hope that I can drive down, or hope that we see lower borrowing costs for me to then refinance in a year's time, 2 years' time. And that's what the focus on T-bills is at the moment, that we're seeing these short-term treasury bills coming into play. That's fine, as long as they can actually bring down yields near enough. And that's why yields continuing to rise will be a problem if they cannot keep a lid on that. And also, as long as they can keep rolling it over and not have to do so for too long, so that year upon year upon year, it all builds up into one short-term sort of huge wall of debt, which is kind of what we're seeing at the moment. But it's only going to get worse if, for the coming years, yields remain high and they focus on refinancing on the short term. So that, I think, is going to be a key theme that we see. If the demand isn't there and if yields remained high, then we're going to continue to see this build up, and it really puts pressure on the system. So that's one area of potential risk, and certainly key to be looking out for. Yields. In terms of the US economy, as with some other parts of the world, but this is very notable in the US at the moment, we're seeing this K-shaped economy. It's a sort of moniker that people are throwing about at the moment. You may or may not have heard it. Essentially, what we're talking about is a divergence in terms of things that often move together. So generally, people all make money together, or the wealthy and the poor should both be lifted as the economy improves. But more recently, there's a feeling that the poor are getting poorer and the wealthier are getting wealthier. There's a number of different ways of showing that kind of theme. One that I have here is essentially the S&P 500. So generally, holders of the index have spare capital to be able to invest. So you would think that would be people that had a bit more money. So the stock market going higher, people that own shares going higher, and then you have the deterioration in terms of job openings. So the economic deterioration set against ever higher S&P 500 valuations. That doesn't necessarily seem like something that can go on forever. And you can see on the left-hand side of this chart, that isn't a relationship that typically is in place. Generally, when the economy is doing well, then the stock market does well, and we see increased job openings. Right now, we're seeing the economy doing well, supposedly according to the stock market, but the jobs market not doing well. And there's going to be a number of reasons behind that. This may be the new norm if you take into account the idea that businesses will benefit from AI, but employees may not. You may lose your job, but that doesn't mean that the company that's sacking you is doing poorly. They might be doing great because they're replacing you with a robot at a fraction of the cost that's going to work every hour that there is in existence. So this is really an interesting one to follow. Do we see this break and we see the S&P 500 roll over because we're seeing a recession in the US? Or is the US economy doing pretty well? We're just using the wrong metric, because if we're just following the jobs market as an indicator on the health of the economy, you're potentially going to miss out on the fact that the economy can do well in terms of the health of the businesses, but the jobs market is going to change with higher unemployment because of the innovations of AI. And notably, what we've seen here is that the recent rise in terms of unemployment is very different from the moves we've seen around the dot-com crash and the financial crisis. We've seen it relatively low levels when it comes to layoffs as the influence of unemployment. So what does this mean? In my mind, this means that we're not necessarily seeing people sacking employees that much, but certainly when there's the opportunity to do so, businesses are likely to either cut costs through not hiring and not filling that position, or just try to utilize AI as a means to streamline their offering. And I think that's likely to continue. I don't necessarily think that businesses are in crisis right now and they have to lay everyone off. But I do think that there is a shift underway that means that we are likely to see higher unemployment, which is what's playing out. This is a sort of overview of the haves and the have-nots involved in the K-shaped economy. Notably, owners of assets, the AI race, holders of stocks, certainly I think is the sort of key part of this. Most notably the top stocks, they are the sort of haves, and there's a feeling that holders of the other, as you have here, 490 stocks, but the holders of the rest of the economy, or people on low incomes and people that don't own assets, they are the have-nots within this. And so I guess that the takeaway from that could be, are you a have or you're a have not? And therefore, maybe I should just jump on the AI trade. Maybe I should jump into those top 10 stocks because they're within the have pile. But perhaps things are going to change. Perhaps as we move forward, we're going to see an increased focus on the rest of that market, certainly as the AI benefit some of these other companies rather than just the main proponents that are involved in the build out. One thing to note is that, as you can see here, there's increased GDP expectations around some of the financial conditions going forward. Part of those financial conditions can be rate cuts. Part of the financial conditions are going to be involved with the fiscal expenditure of the government in the US. But that's not necessarily just a US story. I think that fiscal spending is something that we're seeing in other parts of the world as well. And bear in mind, where we're seeing rate cuts, sometimes it takes a bit of time for that to come into fruition, the same as fiscal policy. So I think from an economic standpoint, the year ahead actually does have a number of tailwinds behind it. Like I said, the AI benefits sort of moving out into the rest of the economy and the other parts of the other industries that maybe haven't benefited so far, the rate cuts that have taken shape but maybe haven't actually benefited people thus far. For example, if you've got a mortgage, if you see a rate cut, your mortgage, if you're on a fix, doesn't necessarily change immediately, but as time goes on, that sort of rolls onto one person after another that actually managed to get onto a new mortgage, and so it becomes cheaper. They have more disposable cash, and so the economy improves as a result. But it's not like the moment you see rate cuts, everyone gets to remortgage on their house. So I think there will be some tailwinds from that perspective. In terms of the AI race, I mean, look, it has become super concentrated in terms of how much of the economy is down to the sort of AI names. And what we can see is that sort of expenditure within these AI names has got to levels where people really question whether it's sustainable. And certainly when you've got businesses that appear to essentially just get their revenues from other businesses and everyone's just spending huge amounts, and now we're starting to see them ramping up debt issuance to try and take on more money to keep investing, there is a feeling that something within that is going to pop unless you actually start to find consumers that are willing to pay big bucks for these new AI-led products, which at the moment you don't necessarily see a huge amount of. And the Chinese, given the fact that they are producing their own products and typically offer them at much lower cost, means that the potential financial implications and benefits for these companies that have been spending a huge amount may be questionable if they're undermined by Chinese competitors. Here's the sort of outlook in terms of spending by some of the cloud companies, the big four in the dark blue, and some other companies in the yellow. As you can see here, ramped up in 2024, even more so in 2025, and it's expected that continues. certainly if we start to see a turnaround in that and we see a top in terms of the spending of these companies, then that could be a major sign, warning sign, particularly for the US markets, which are so heavily reliant, as we see here, on these big tech names and the AI trade. And that's why people might start to diversify more so away from these stocks that people are progressively thinking are particularly at risk. And as you can see here with those sort of black diamonds, that's the year-on-year growth rate that has sort of been on the rise, but it's expected to start tailing off before too long. This is another way of looking at it. Each year, the way that the capex estimates just continue to rise and rise and rise, it's just getting exponential. And I guess you could say AI is all about becoming exponential, but it doesn't necessarily look like something that is super sustainable. And so there's got to be some sort of blowout top. And what's the implications for such a blowout top? Is it just going to be for those companies, or is it going to be something that causes contagion throughout the entire stock market? That certainly is a major risk as we move forward. Michael Berry has been piping up of late, trying to talk down all of these big tech names because he's got shorts across a handful of them. And part of his story, his narrative is around depreciation costs, because he essentially says if you buy chips and you put them into a data warehouse, you know, it might last 2-3 years, and soon enough that chip's worthless. You're going to have to get new ones and replace it. That may be the case. Certainly these companies are currently putting down that depreciation as being something like 6 years, 7 years. So his argument is that they are essentially cooking the books by making it out like that value, this huge amount of value, isn't lost as quickly as it is. But notably, these companies have only really been investing in this kind of manner to this extent recently. So when you're talking about, oh, is it 3 years? Is it 7 years? At some point that comes back to bite, right? Because we essentially do see the reality of it. If that chip is no longer in use after 3 years, then he's proven right. If it's 6 years down the line, you're still using that chip from before, which seems a bit far-fetched, then maybe he wasn't right. So the reality is probably something in between. But certainly if you look at the demand that NVIDIA is saying that they have for their new chips, everyone wants to just jump on the new chips because of the huge benefits that each chip has over the last. That would point towards the idea that much of the spending you're seeing at the moment is on products and chips that soon enough they probably will just say, oh, they're old now, we don't want that, we need new ones. That would be good for companies like NVIDIA, where there's just a constant demand as long as their product continues to increase. But it raises questions for companies, as you see here, like Meta, like Microsoft, like Alphabet, that have spent a huge amount of money. And soon enough, the thing that they've spent money on is pretty much worthless, and that gets put onto the books. So that is certainly a risk associated with AI going forward. Notably, when we're talking about the strength of AI versus the rest of the market, you can see here earnings for the likes of the Mag 7 versus the 493 over the course of 2024, 2025. It's narrowing the gap between the two. So a deterioration in terms of the growth rate for earnings for the Mag 7, but increased growth for the rest of the market. So like we said with that K-shaped economy, previously it was saying, well, the winners and the losers. Well, the winners have been people holding these big tech names. The losers have been those holding the rest of the market. Do we start to move towards a period where people see the risk as being associated with those winners, the big tech names, and the potential gainers being the rest of the market? Potentially, and certainly, like we said, you know, some of these measures, when it comes to fiscal measures and tax measures, whether it comes to interest rates at the Federal Reserve, a number of different tailwinds that could really significantly benefit some of the other businesses. Also, AI not just benefiting the companies right at the top of that stack. So that's going to be a potential theme for the year ahead, the potential sort of widening of the breadth for stocks that are doing well, where people start to try and diversify away from just holding big tech. Now, diversification isn't just a case of looking in the US market, but for different stocks within the S&P 500. In actual fact, more recently, we've been seeing growth in terms of earnings outside of the US, holding up relatively well compared to the US. In the past, when you're looking for high growth, it was all just a US-led story. That isn't necessarily the case anymore. And we have Donald Trump to thank for some of this, because essentially he's created an environment with his isolationist approach that everyone's realized they can't rely on the US anymore. And that means that they might just ramp up spending on domestic projects and alike. We're certainly seeing that within mainland Europe. And you're seeing that within Japan at the moment. So a lot of countries are going to try and become self-sustainable to an extent and increase stimulus measures to try and boost the economy. So earnings in other parts of the world do look relatively attractive going forward as a tailwind. And given the risk that you have around the whole AI trade, I think there's a strong case for investing in other parts of the world as well. So if you've got, say, a tracker within your pension and it's currently geared just towards US stocks, it looks quite attractive to take that into one that is maybe taking into account worldwide stocks rather than just US-centric stocks, because the risk on the AI side is heavily geared towards the US. And many of these countries are enacting stimulus measures that means that we will see earnings doing relatively well in comparison to the US as well. This is kind of playing along the same narrative. And you can see here that period, 2010 to 2019, we saw very little in terms of nominal government investment, so fiscal expenditure from some of these top economies, the US, the UK, Japan, the Eurozone. That's changing. So 22 to 26, we're seeing a significant ramp up. And as you can see, the top of the pack, the Eurozone, part of that's going to go towards defense spending. Certainly the Russians are, well, who knows whether they're going to have a deal between Russia and Ukraine, but even if there is one, I don't think the Europeans are particularly going to suddenly feel like they can trust the Russians. So it's likely they're going to continue to spend on defense, continue to spend on infrastructure projects. And like I said, in the absence of US support, the Europeans really have to step up. So increased fiscal expenditure, expansion, and that means that we're likely to see attractive sort of outlooks for some of these other areas. And again, this is a similar kind of story. So what we can see here is the year-on-year change in earnings growth for the rest of the world. So the MSCI world, excluding the US, versus the US, we've actually seen the rest of the world's earnings growth overtake the US. And that's considering that the US has, a huge amount of massive companies that have been growing at very impressive clips. So what happens when they don't? Well, it's likely that the rest of the world could suffer, but certainly not to the same extent as the US. So yeah, that diversification story outside of tech, I think, is going to grow in the year ahead, and outside of the US is likely to grow as well, as people remain fearful of the risks going ahead. Yes, we saw that tech jitter, and then we saw many of these tech names push higher once again. I think those jitters are likely to come back into play time and time again as we approach earnings season, because everyone's worried that we're suddenly going to see the top in the big tech trade. And finally, I think this is the last slide that I've got. So a lot of slides here. But again, when we're talking about some of these other markets, you can see the relative valuations here. So the NASDAQ, of course, heavily weighted towards big tech, well over and above some of these other big names, the S&P 500, even significantly below that. So highly concentrated on big tech, the NASDAQ. But nonetheless, US equities, much higher valuations on a PE basis compared to the likes of the FTSE, the S&P, the FTSE, the CAC, the DAX, and more. So keep an eye out for that as a potential theme as we go forward into 2026. Aside from that, I will leave it there. We've already gone on for half an hour. Like I said, we've got a webinar where we're going to be going through a lot of these different topics and talking about it, but also going into the charts and looking at exactly how things are shaping up from that perspective to try and gauge exactly how we should approach 2026 from an investor standpoint and from an active trader's standpoint. Other than that, please like, subscribe, follow for more content like this. Sign up for the webinar, please. I believe it's on the 12th of January, kickstarting the new year. And yeah, have a great day, have a great New Year's, have a great festive period and all that. My name is Joshua Mahony, Chief Market Analyst at Scope Markets, signing out for now. Goodbye.